100 baggers are the dream of any investor, a stock that gives you a 100 times return, and they're rarer than the Charizard Pokemon cards that you used to collect. But they are achievable if you know what to look for, and you only need one stock to make just a few 100% returns in order to completely change your life. We're going to look at how to find 100 baggers in this video and what exactly you need to check for in order to identify them. So the most important thing that you need to check for is if the business has a moat. Now, a moat is something that protects the business from its competitors. For example, there was and still is a company in the UK called SafeStyle, which made and installed UPVC windows at really high margins, but then other people saw how much money SafeStyle was making and decided to do the same thing and just undercut them, and it became a complete race to the bottom. Any business that doesn't have a moat is seriously going to struggle in the long run, because if it doesn't, someone else is going to come along and just take that business's lunch money. A good example of a moat is Ryanair. Now, I know a lot of people love to hate this business, but it doesn't take away from the fact that this is a really good moat, even if the CEO did want to start charging people to use the toilet.
If we can find a mechanism of charging for toilet access, it would make perfect sense to me to charge for toilet access.
So Ryanair's moat is its relentless focus on cost, and it actually sells seats cheaper than what it costs its competitors to even run a seat. So by offering lower fares, it attracts more business, and then it pushes that business through to its app, My Ryanair, in order to upsell people to boost the business's returns. So it uses that capital and volume to lower costs and get better deals on planes and with suppliers. And this then expands the model and allows Ryanair to offer even cheaper prices. So with the cheaper prices, it attracts more business, and then the cycle continues and Ryanair's flywheel spins faster and faster. So because of Ryanair's focus on cost, it's going to be very difficult for a competitor to come in because of the sheer size and scale of Ryanair, and because it's so focused on cost, there's not very much a new airline can do. Hence why Ryanair has a moat with its cost. Another feature of 100 bagger stocks is that they need a big runway for growth. You can have a really good business or a great business, but if it's limited in where it can sell to, so for example a quarry, then it's never going to achieve that 100 bagger legendary status. And a lot of 100 baggers businesses are actually tech companies because of the scale that they offer and the amount of people that they can sell to. Companies such as Amazon, Alphabet, Microsoft, Netflix, but 100 baggers don't necessarily need to be tech companies, but often 100 baggers will be tech companies, if that makes sense. But one company that isn't a tech company and you might have heard of is called Monster Energy, which is completely disgusting and not something that you should drink or your children should drink on a regular basis because it's full of sugar. But this became a 100 bagger in 2006, and by 2014 it had actually become a 700 bagger, and it did this not only because it had a global market, but because it had strong branding and marketed that brand really well. It does sponsor athletes and events like Red Bull, but unlike Red Bull, it doesn't focus on ads, so this gives the whole brand a very cool, high quality image. So this high brand equity allowed it to reinvest and continue to grow aggressively. Another reason for Monster Energy's success is because it outsourced the bottling and manufacturing. That means it doesn't have to focus on buying expensive machinery and investing in maintenance capex, but it does allow that capital to be freed up and then reinvested into the high margin marketing of the business. Companies that are able to generate high ROAS ratios or return on capital employed ratios and have an asset-light business model can be hugely profitable, and they can be brilliant stock market winners. So think of the ROAS ratio as the company's own interest rate. This is the returns that it makes on the business when it reinvests that capital into itself. So if a company can generate high returns on the money that it invests in itself, it can then take that money and reinvest it again aggressively into scaling the business even further. And this just means businesses can turbocharge their own growth with asset-light business models and high ROAS ratios. And this is why tech companies have an advantage, and why some of the biggest companies in the world are tech companies today. They have high margins and a lot of their costs are actually fixed, so any additional incremental revenue does trickle down to the bottom line and is converted as profit. Another feature of 100 baggers is that they are likely to be owned by owner-operators at some point in the company's history, and this is because managers who aren't aligned with shareholders are more likely to focus on the short term and not care about the long-term investment of the business as such. They're more likely to be focused on the value of the salary rather than the share price. And if you think about it, a director who has a tiny or no shareholding in the business isn't really going to think twice about diluting shareholders into oblivion if it means they can increase the size of the business, move into fancier headquarters and give themselves more prestige. This is known as empire building, and it's something to be aware of, because having 400 employees and a fancy office space certainly sounds better than 200 employees and a rundown industrial park office, especially when they're not the ones who are paying for it.
Aerotine International. It is a cutting-edge, high-tech firm out of the Midwest.
But owner-operators are entrepreneurial, and they're more likely to have founded the business, or they have a decent stake in the business, or skin in the game, as they like to say. So this means that they will actually be focused on the long term of the business and the long-term share price as well. Basically, they aren't going to be Jobsworth clock punchers.
I forgot to punch out.
And they're going to be focused on getting the job done. So a good place to find owner-operated businesses and to have a chance of achieving a 100 bagger is to hunt in the right arena, and in this case it's small cap stocks. It's much easier for smaller companies to become big rather than it is for big companies to become even bigger. Not saying it can't happen, it absolutely can, but it is a lot easier for a small company, the right company, to become a lot bigger and give you that chance of achieving a 100 bagger return. And again, I'm not saying big companies can't do it, but if you think about it, every big company now started very small and had humble beginnings. Some of the best companies in the world, such as Google, Amazon, Apple and Microsoft, all started in garages and delivered huge returns for shareholders, although not for Ronald Wayne, who sold his 10% stake in Apple 12 days after he'd founded the business with Steve Jobs and Steve Wozniak for $800.
You blew it.
But in the UK market, companies like Next, ASOS, JD Sports and Domino's have all delivered fabulous returns for shareholders, and the big winners of tomorrow will be found in the small cap companies of today. In fact, finding 100 baggers is actually easier than you think. Nick Train found that in 2019, 12 of the then FTSE 350 had 100 bagged since 1980. And yes, that is only 3.43% of the total companies in that index. But 65 of these companies actually went up 20 to 50 times in that period. So that means you had a more than 20% chance of at least making 20 times your money if you bought a randomly allocated stock in the FTSE 350 in 1980. However, you do need to be mindful of the earnings multiple that you pay when you are looking for 100 bagger stocks. Microsoft might be one of the best companies in the world today, but it did take 16 years for those who bought it in .com. And remember, Microsoft was a .com winner. It took 16 years for those who bought then to actually break even on the stock. So earnings multiple is a very crucial factor when you're evaluating potential 100 baggers. The reality is you can buy a great company, but if you pay too much, this is going to have a hugely negative impact on your total returns when you are holding the stock. But even if you never find a 100 bagger, you only need one multi-bagger to change your life for the better. And if you're hunting in the small caps market, which is inefficient and illiquid, so long as you are following the ideas in this video, you are actually gearing your odds in your favour. Most people have no problem finding multi-baggers, but they often get scared of holding, or they sell far too early, so they never actually achieve that multi-bagger status. Finding multi-baggers takes time, and if you ever want to have a chance of achieving that 100 bagger status, then you need to make sure that you've backed the right company, and you also need to be prepared for some stomach churning volatility. Amazon was once down 90% and it's halved in price several times, so you either need a stomach of steel or you actually best just to forget you even own the stock, because that is probably very difficult for most people at the IPO to have held. I don't think I'll ever hit a 100 bagger for this reason, but I have held numerous multi-baggers in my career so far. Let me know which company you're currently holding that you think is a multi-bagger in the comments below. Thank you very much for watching, and if you can like and subscribe to the channel, it really helps me out, and I will see you in the next one.